Right, welcome to this very special webinar presentation brought to you in collaboration with ACG New York and Silicon Valley. Delighted to have you with us today. We've got over 400 people and registrants that have signed up to join us today for this amazing topic that we'll be covering today on SPACs and how they're changing the IPO and M&A markets, a very pertinent topic that we're focusing in on for the next hour or so, and a brilliant speaking faculty that we have for you today to guide us through the subject. But before I can introduce them and talk us who can talk us through the hour, I just wish to say that we want to make this as collaborative as possible. So you will see on your control panel as listeners a chat function. Please field questions on there so that our panelists can answer those during the course of the hour as best as they can. And so without further ado, let me introduce to us, or to you rather, our panelists. And like I said, it's a brilliant speaking faculty that we have for us today. The first is Jonas Grossman, partner and president of Chardon, where he oversees the firm's banking and capital market activities. Thank you to you, sir. And then we have Tina Pappas, who's just joined there, or for a moment at least, managing director in equity capital markets at Jefferies, and has over 25 years of investment banking experience, particularly with SPACs, and I believe has completed over 47 of those transactions. Next up, we have David Boris, who has over 30 years of Wall Street experience in mergers and corporate finance, and has been involved in approximately 20-odd SPAC transactions as an advisor, investment banker, plethora of things that he's done in that, totaling, I believe it's being over 5 billion in transaction total. And last but not least, we have Jared Kelly of Reed Smith, who are our partners for this presentation today, and my thank you to Jared. And with him, we have Craig Lilly, who's the moderator for today, and Craig also with Reed Smith, who will be guiding us through the next hour or so. So Craig, having said all of that, there's the waffle over. Over to you, sir. Thanks very much.
Well, Vic, thank you for the introduction. We're very excited about our first joint ACG New York Silicon Valley event. There's no better topic than to discuss the Special Purpose Acquisition Corporation. 70 SPACs have raised an unprecedented $31.2 billion this year. Compared to last year, there were only 59 SPACs for the total year that raised $13.6 billion. So it's a very hot, obviously, Special Acquisition Corporation or SPAC market. I'll first turn it to Jonas. So for our first question, I understand that you've advised on multiple dozens of SPACs or underwritten SPACs over the last numerous years. What are the reasons for the explosive growth in SPACs in 2020?
Well, I'd say that the seeds for the growth have been occurring over the last 3 or 4 years. I think if you look back to 2015 and 16, you saw some high quality sponsors, blue chip private equity and the like, become more involved within the space. And you also saw some transformative back end transactions occur. And I think that, we were slowly building at a sort of 20 to 25% of the IPO market within the US. One of the big advantages, which I'm sure we'll get into soon enough, of SPACs is certainty of listing and the ability to guarantee capital through the transaction. And when COVID hit here in recent months of this year, and markets became very volatile, it became very obvious, I think, to many parties that the SPAC had a good advantage to the traditional IPO. And so this year has seen sort of an explosion of additional SPACs come to market, really high quality teams, big support from a broad investment banking community and better understanding of the back ends and the D-SPAC. And so that's really driven the growth in 2020 so far.
Yeah, recently there's been a lot of interest or a lot of electronic vehicles or auto tech SPACs. There's been 4 recent SPAC acquisitions announced. So that's one of the differences, I think, right now with SPAC is some of the new areas within the SPAC sector. David, how are SPACs different in 2020, and what are some of the kind of the recent trends you've seen in the last kind of 6 to 12 months?
Well, I would echo some of what Jonas is saying, as dead on. I think what's different about SPACs, and this I'm now co-CEO of Forum Merger 3 as well as Forum Merger 2. And so we've seen this, firsthand from our first SPAC as principals to our third. The number of companies and the quality of companies willing to engage with SPACs that are taking SPACs, not only seriously, but I think SPACs in many cases are the first choice. When a company is seeking capital to grow to its next level, it used to be that they would consider a private equity transaction or possibly an IPO, and then some small subset, had heard about SPACs and were willing to get there. Now I think, when most investment banks are out talking to financial sponsors about liquidity and what to do with portfolio companies and opportunities, I think there's probably almost always now a page about SPACs as a real valid alternative. So we're seeing, better deals with, high quality investment banks. And I think that that's because, we're seeing some good successful transactions in the de-SPACing process.
Tina, what are your thoughts on that? Are there any specific trends that you would like to discuss that have occurred over the last 6 or 12 months in SPACs?
Sure. Yeah, I think there are a number of trends. I think you've seen a proliferation, obviously, of IPOs, but part of what's fueling that is that there have been a significant number of well-received transactions, and it kind of flows from, what David mentioned before. Some years back, it was pretty challenging to get the attention of high-quality companies to transact with a SPAC, and now there are, very institutionally relevant companies. The average SPAC business combination today is well over $1 billion. So these are sizable companies that deserve to be public. And the sponsors of the SPACs are facilitating that entry into the public market, but they're really companies that should be public. And most of the deals in the last 6 months, I would say, there are a lot more, have been a lot more warmly received, have traded better, have had the attention from long-only fundamental institutions and not just sort of SPAC specialist investors. So all of those things have helped, fuel both continued issuance as well as, garner the attention of, high-quality companies, target companies.
From a sponsor or a founder of a SPAC, what are the advantages of a SPAC to a sponsor? And Jonas, we'll start with you.
So look, as a sponsor for a SPAC, you're really betting on that yourself plus the management team can use your experience in a particular industry or geography and find a very compelling company to bring public. And so you're betting on yourself to put together a transaction. You're putting up a significant amount of risk capital, but your reward for executing on that is quite significant. SPAC transactions are not easy, and as any sponsor and management team will tell you, they're an exercise of convincing a company to go a route versus other routes, and there's a timing mechanism. It's an M&A transaction and a capital markets transaction, and markets change, valuations change. You have to try to catch it all just about right. However, sponsors are very intrigued because many of them are already conducting the diligence on these companies, already potentially serving as anchor orders within IPOs. And so being able to take a more hands-on approach on a specific transaction with great upside is intriguing for many different groups. And so you've seen private equity get involved. We've seen even venture now getting involved on this. Each sector's got a slightly different nuance of why a SPAC could work, but ultimately, sponsors are intrigued because if they have access to deal flow, they have capital, they have the ability to diligence and lead and negotiate a transaction alongside underwriters. It's very intriguing for many folks, and that's why the sponsors are attracted to the SPAC structure.
Tina, I was wondering if you could just discuss that as well, and maybe for the audience, maybe help to discuss maybe the typical kind of share structure for SPACs as well. Well, I think we lost Tina there for a second. So why don't we go to our first poll question, which is, what is your role with respect to your company? right. Well, I think we're having a glitch there with the poll for a second. Well, I guess my next question, I'll talk to Jared next on this, is typically when a SPAC makes an acquisition, they call that the de-SPAC process. Jared, can you talk a little bit about that as far as the timeline and the process for the de-SPAC process as well?
Yeah, absolutely. I think, the de-SPAC process is something that is unique, obviously, to the SPAC and industry, and you can become very creative as a lawyer and as a business person structuring these. And so when I think about the de-SPAC process, I typically break that down into sort of 3 stages. One is when you identify the target and begin the merger acquisition negotiations. And this is the lawyer in me talking, so it's going to be a lot of generalities and things like that. So it's, in a typical deal, you might find 1 to 2 months of negotiation, hopefully, and sometimes obviously they can string longer or shorter. But you have to look at the target's existing capital structure, figure out if you want to flatten that structure, figure out what you want to do with existing debt, existing stockholders. So all of those initial, meeting of the mind, so to speak, on if you have a deal or not, that can take some time to paper up and put that together. You also have to consider if you need additional financing transactions. Typically you do. If you're going to just have new debt, going to have a private placement through the form of a PIPE. If there's a forward purchase agreement involved, where is your secondary capital going to come from? And so all these bigger ticket issues sort of negotiated at the outfront. And then you have the next stage. Once you get to your definitive agreement, the next stage that I think about is the proxy, tender offer, redemption phase, whichever component of that you have to do. So now you draft a disclosure document to be filed with the SEC, and proxy rules require a lot of disclosure, similar to what an EGC would do in an IPO in many respects. You have to get financial statements for the target, which in some cases the target doesn't have the proper financial statements. They might not have PCAOB or AICPA financial statements yet, so that takes some time. Usually, this stage can take somewhere between 3 to 5 months. Best case scenario, drafting all the disclosure, filing it with the SEC, going through comment period, mailing the proxy, holding the meeting, et cetera, and then once you have an approved deal, all along the way, obviously, there's politics and jockeying and things like that go into place that are behind the scenes. I'm sure now every deal has a sort of different political aspect to it behind the scenes. But after you have an approved deal and you've gone through the redemption feature and you know how much capital is going to come in and you know what your post structure capital cap table is going to look like, you have to close the deal, and that requires obviously satisfying conditions in the merger agreement, getting other aspects like D&O insurance put in place, and doing what we call the Super 8K, which is effectively a Form 10, which is an SEC document similar to an S1, not quite as burdensome, but you do the Super 8K, now you need PCAOB financials, and then you're off to the races. The wires start flowing and everyone starts running a public operating company.
Well, we talked about the advantages of a SPAC to a sponsor. Tina, what are the advantages to a target company of why they would want to be acquired by a SPAC?
Sure. So, I mean, there are a number of advantages. I agree. I mean, I think Jonas mentioned before, it's both an M&A transaction and a capital markets transaction. So it's really thinking about it as though you're doing an alternative IPO. And the benefits are that it's a negotiated transaction like an M&A transaction, but also the process and best practices that are in place today. So that gives you greater amount of certainty than a traditional IPO process. So in terms of picking the counterparty, picking the SPAC that you're going to partner with, There could be benefits associated with that sponsor and what they bring to the table, whether it's capital or relationships that can be, beneficial in the business combination, but also with the company going forward, so that, who the sponsor of the SPAC is could be an advantage to the target company. Also, in terms of comparing it to an IPO, oftentimes you can monetize your equity to a greater extent than in a traditional IPO, and that could be meaningful in some cases. And the flexibility of the vehicle, whether it's including an earnout in your transaction, which is not something that you see in an M&A context, could be a significant higher valuation in the public markets versus where the company would trade in a PE sale or a strategic sale. So valuation could be one of the motivating factors. But also, going back to the comparison versus an IPO, the marketing of this, there's a pre-marketing aspect associated with the what we call the de-SPACing process. So once you have a handshake on a deal and the basic parameters around valuation, you can take investors over the wall and market the deal.
I think we might have lost Tina.
Yeah, I think we lost Tina. Maybe Jonas, maybe you can explain that too as well.
I'm trying to finish the sentence there, but I think she was really highlighting that one of the advantages is that you can pre-market the transaction before you sign a merger agreement. And so if you're a target company, hey, Tina, I just kind of kept on with your sentence there. But if you're,
no, go ahead. I got dropped. Sorry.
No problem. If you're a target company, being a traditional IPO, a lot of the risk on the transaction is on your roadshow, which occurs at the very end of the deal after you've hired lawyers and bankers and conducted a lot of work and been through a quiet period. But through a SPAC, you can pre-market things confidentially, make sure your anchor orders are in place, and really before expending a lot of money and going down this whole route, can understand what the support was from which investors and for how much and at what valuation, and how to bind those in place before you sign a merger agreement, which is a big advantage to a traditional IPO process, especially when you have volatile markets.
Okay, Jonas, also I'm curious, what are the challenges right now in the marketplace for SPACs? I mean, are there any disadvantages right now as well for SPACs?
I mean, I guess it depends which stakeholders you're looking at. I think from a sponsor perspective, there's a wide open IPO market, so it's relatively straightforward to raise capital on good terms. There's interest from target companies to explore that. I think one of the challenges are there are a lot of SPACs now in the market. So you have over 100, 125 out there looking for various targets, and to the extent that there's overlap and some folks are competing for the same target company, it can be a little bit more challenging for the sponsors themselves. I think it's probably a good thing for the target company universe. And then at the end of the day, you have to ask yourself, how much, there's two sets of investors. You have how much supply can be absorbed in the IPO market up front, and then, how much capital is there for these back-end transactions, which can be multiples of the actual IPO raise. So if there's, 25, 30 billion out there looking, I think it's 30 billion plus right now, you may have to raise 50 billion plus in capital over the next 18 months. And so what's the demand profile going to look like? Where the market's going to be? These are all things that kind of factor into the calculus.
Well, there are more SPACs going public than any other IPO sector. So we're going to go to our next poll. And our next poll, let's see here if we can get it going. Our next poll is, as an executive in a pre-IPO company, would you prefer a SPAC versus a IPO? And I guess while we're waiting on the results for that, Tina, let's go back to you. When you advise a company, whether they want to do a SPAC or IPO, what are some of the key differences that you discuss with them?
Yeah, I mean, we were, before I got disconnected, before I was running through a few of them. So, flexibility, amount of liquidity for the seller, is often a key consideration in determining which path to go down. As I mentioned before, the fact that it's a negotiated transaction where you're entering into discussions with either one party or a very sort of narrow list of potential partners, and you really are partnering with the SPAC sponsor to take the company public. So sometimes there are actual, benefits to the partnership. It could be a group that has a lot more capital markets experience, taking companies public, perhaps prior SPAC experience, sponsors like David and his partner, or it could be an institutional SPAC sponsor where they can, commit capital to help de-risk the transaction. So one's sort of picking a partner, so you're not in it alone, the way that you are in an IPO situation where, it's more difficult to engage with investors on your own. So you have a partner, and then it's all the flexibility of the vehicle. So the fact that you get to negotiate an earnout, perhaps the fact that you get to wall cross investors, so that you have price discovery early on in the process, and that's a big actual motivation for transacting with SPAC is price discovery. You get to take investors over the wall early in the engagement with the SPAC partner. You get receptivity and feedback from investors, and you can also get committed capital through a PIPE as part of that pre-marketing process, so that before you ever enter into a binding agreement with a SPAC and publicly announce a transaction, you have a certain amount of capital that's committed, and you have visibility, and then you have price discovery after announcement, because every day you can see where the SPAC stock price is trading, and you can see the results of your marketing effort after announcement, and you can engage directly with investors. And I guess the final point that I didn't mention is that you can also provide projections in the context of a SPAC transaction because it's a merger. So you can directly, without the filter of a research analyst, you can directly tell the story and provide, sometimes very detailed financial projections that, especially if it's a company that's very high growth, which has been the profile of some of the recent successful business combinations with SPACs, you can, really lay out for investors, the growth trajectory of the company and provide a lot of detail there. So those are some of the benefits that draw companies to the SPAC path.
Yeah, based on our poll results, which are very favorable to SPACs, 2/3 of the poll would rather pursue a SPAC versus IPO, which tells you a lot about the excitement about SPACs. Jonas, do you have any further thoughts on that, about the key differences between pursuing a SPAC versus an IPO as a emerging company or a technology company?
I think Tina highlighted a lot of them very, very well, but at the end of the day, the IPO is a very risky endeavor for a private company. There's a lot of risks about the process, constraints around it in a traditional IPO way, and getting a partner through a SPAC and de-risking a lot of that is very valuable. I think at the end of the day, that's what's really been driving a lot of the interest from private companies to go through that SPAC route. I think Tina articulated it quite well, just the different stages of how this comes together, how the commitment up front to explore this, to understand if there is capital committed is a big advantage for certain private companies. You still have to be mindful to create a public-ready company. So some companies think that the SPAC is just a way to raise capital. At the end of the day, even post-merger, you are a public company, so you have to be able to handle quarterly calls and the marketing and investor outreach that would make for a successful post-business combination. That's something that folks need to focus on if they're thinking about that SPAC route. But a lot of the elements that you get in an IPO, whether it's research coverage, support from broad syndicates of banks, are coming along now within SPACs. It's really widely followed part of the IPO market. And so I think that's what's attracting many more private companies. They get a bigger say in the actual transaction versus signing up with underwriters and then, having a negotiation at the end of a roadshow on pricing. And here they can have a real say in different elements along the way.
Jared, what are some of the key SEC issues to keep in mind with respect to SPACs?
Yeah, sure. So I think this is sort of after the SPAC comes in after the de-SPAC process. I think it's always, sort of important to keep in mind when you're able to take advantage of some of the SEC rules, like being a well-known seasoned issuer and registering your employee benefit plan on an S8. So in a traditional IPO, you'd be able to file your S8 and register employee stock plans immediately. And here with a SPAC, you have to wait 60 days until after you file the Super 8K. Initial SPAC investors are not eligible to use Rule 144 for secondary sales until 12 months after the 8K is filed. That can affect your liquidity, although most of the time you have registration rights, et cetera. So sometimes you can use those. Along with that point, the SEC's recently sort of decided that the SPAC eligibility for Form S3, which is a short form registration statement, is only available after 12 months of the Super 8K. Some SPACs before had sort of gotten away with or taken advantage of the initial filing of the S1 and becoming a public listed SPAC and only tacking from 12 months from that date. But the SEC sort of through informal guidance and comment letters have said, no, you have to wait 12 months after your Super 8K filing, which is after the de-SPAC transaction. The last one here from an SEC point of view is the ability to use free writing prospectus and marketing materials is sort of limited for a SPAC as compared to a traditional IPO route.
Well, our next question, we're going to take one from our audience. And the question really is, what are some of the best practices of those who have gone to the market and some of the lessons learned? David, we might start with you to see if you have any thoughts on that and then go through the panelists.
Sure. Well, I mean, I would say from the forum perspective, we try to do a lot of things. We try to, and some of these will sound a little hokey maybe, but we try to be honest, so when we're approached by, a sponsor, and I know there's a lot of sponsors in the audience here. So when a sponsor is kind enough to say, hey, does my portfolio company fit with your SPAC, or for any SPAC, spend a lot of time. I know all the bankers on this panel and lawyers do too, but we spend a lot of time educating sponsors about SPACs and how they work and how they don't work, because it's good for forum, but it's also good for the whole market. We don't believe in throwing a lot of spaghetti on the wall. If a company's interesting, we want to engage with it. If it's not, we don't try to keep it alive, and we don't have 30 LOIs flying around at a time, whereas other SPACs sometimes do that. And I think that gives SPACs potentially a bad rap in the market. I think sponsors want to know that they're dealing with a professional management team who's taking the transaction seriously, that has access to the capital, that's using good advisors, both on the banking and the legal side. And I think, all of those things matter when you're, trying to do a transaction that we know is extremely important to both the SPAC shareholders and the stakeholders in the target.
Jonas, do you have any thoughts on that, on best practices or lessons learned for companies going through the SPAC process?
I mean, I think if you're a company going through it, you have to be realistic about what you want to get out of this process. I mean, SPACs are very good at problem solving, so you can create a bespoke M&A transaction to solve certain stakeholders' interests within a company, whether that's a sell down for certain investors or otherwise, and hopefully you can solve that. But at the end of the day, you have to you're creating an IPO book of investors. So you're really looking, if you come to the table with a management team that that understands how to be a public company, that has support from their existing shareholders to stay through the transaction, is always well thought of. Typically, if you have anchor investors that you have relationships that might come through, this puts you in a better position to negotiate with various SPACs. If you don't have any of those, it doesn't mean it wouldn't work with a SPAC. It just means that there's a little bit more work to be done on the SPAC sponsor side on the transaction. So those are some of the things. It's really about hiring advisors that understand SPACs. It's a unique transaction that's got some nuance that's important to get not only from your advisors, but from the banking side, but also from the legal side and otherwise, and auditing. And just be honest, I think, from both sides. David, as you said, it's from, no SPAC team wants to waste time with a deal that isn't going anywhere. And it's some private companies that go after 6 or 7 or 8 SPACs, and everyone knows that they're shopping it around. Most teams will just move on to try to find other opportunities, because at the end of the day, it's a fit. You need to feel comfortable that you trust the management team from the SPAC, and they trust you, and you're working at this together. The SPAC team is under the gun. The fuse gets lit when the IPO is done. And so they're looking to find a partner they trust to really put an effort in to try to get a deal done. And to the extent that there's commitment early on and just being honest about what the different sides need for this transaction to work, that's going to be helpful for everyone, I think.
Yeah, there's been
if
more.
I can just
Yeah, go
pile on
ahead.
that for 1 second to Jonas's point. I think this is all relatively new to a lot of people, right? And so everybody's trying to figure out kind of how to work with each other. But I guess, my advice to sponsors out there is to treat these SPACs like you would want to be treated yourself if you were in a process, and you would treat other sponsors. I mean, I did spend 30 years as an investment banker, and so I, understand that side of the table as well. And, we've seen a lot of sponsors say, well, I have this portfolio company. I don't know what to do with it. Let's show it to a SPAC because, they'll overpay or they'll do something silly. And, and it's an efficient market, and that's not how it works. And everybody wants a transaction that's successful, that trades well in the market, that has good equity research. And so now you're seeing sponsors, saying, instead of saying, I have this company I don't know what to do with, they're saying, what's the best company in my portfolio, and let me talk to SPACs about it, because that's the company that will perform the best in the public market. And I think that's an interesting and an important trend. But I think SPAC managers need to treat sponsors and such with respect, and not waste their time, and vice versa.
There's been a lot of commentary that one of the key advantages of SPACs is their flexibility and structure. Tina, in the last few years, how have SPACs changed in structure? Are they safer investors? How are they perceived? And talk a little bit about the flexibility of SPACs in that regard.
Well, they've always been safe for investors because the capital is going into treasuries and is held there until a business combination is presented for approval. But I mean, the point on structure and the evolution of the structure, the evolution of the structure continues. It's been product that's been around for a very long time and has evolved quite a bit. And most recently, even earlier this year, they've seen a number of changes in the structure. You have up on the page the Pershing Square SPAC, which I was involved with, and there's been some other deals recently, including this week, that have some changes to the structure, and they revolve around things like the promote, whether it's a more of a grant the way it typically has been, the 20% promote that is still almost ubiquitous in the SPAC product. There have been some recent transactions, including the Pershing Square SPAC, that deviate from that, and for good reasons specific to what the sponsor in that SPAC is trying to accomplish. But I think you have seen some variability on things like warrant coverage. We did a deal earlier this year that had no warrants. It was the first SPAC to have no warrants. That was specific, really to the biotech sector. And so you have seen variability on things like warrant coverage, on things like SPAC sponsor promote, whether some of it is held back until the stock trades at certain premiums to the initial IPO price. And I think they're all trying to get, all of those changes are trying to get to two things, which is doing a better deal and, you know, providing not certainty for investors, but, you know, basically a capital structure that will be most, you know, allow the company to be most successful in de-SPACing and being, you know, less, providing less friction for the existing shareholders of the SPAC. There are a number of ways that you can accomplish that, even with the traditional SPAC structure. The traditional SPAC structure is extremely flexible. So just because you have, you know, a certain amount of promote shares outstanding at the outset, it doesn't mean that the sponsor of the SPAC can't decide to make concessions to close a business combination. So I think that's the beauty of the structure, is that just because there's a particular set of terms that the IPO went out with, there are ways to you know, accomplish what a target is looking for, even if you don't have a unique structure. I think what it all points to, though, is that the market has evolved to where there are a lot of different types of issuers and a lot of different types of investors. And, you know, for the right situation, you know, if it's a very well-known sponsor, you know, you can have lighter warrant coverage if they're providing significant de-risking to the back-end business combination. You know, if they have a very particular strategy which informs a certain type of shareholder base, those are all things that could point to a more unique capital structure for the SPAC. With that being said, I think you'll still continue to see the bulk of SPACs, you know, have typical terms, because it's still a great vehicle. It's still very, very flexible, and, you know, most transactions can be, you know, well executed with the traditional SPAC structure.
Next, we'll take a question from our audience, and we're getting a lot of questions about the sponsor economics. And Tina, you kind of touched on this. Jonas, what are some of the trends you're seeing as relates to sponsor economics? Have there been any changes in sponsor economics over the last 6 to 12 months?
I mean, there have been some recent changes, which Tina touched upon on the sponsor economics side, but they've been very stable for a long period of time. You know, for many, many years now, sponsors put up risk capital, which they'll get some sort of security for. It'll either be a warrant, a common, or a unit around that. And they typically start off with 20% of the capital raise. So if we raised a $100 million SPAC, you'd have $25 million worth of sponsor equity, which is 20% of the combined $125 million. So that has been around for a very long time. As Tina pointed out aptly, that does, just because you start with those economics doesn't mean you end up with those economics, and that'll just depend on the negotiations with the target company. Recently, you've seen trends to try to take the dilution out of the SPAC itself, and so that would mean in certain sectors, like in biotech, you've seen straight common transactions and reduced, I guess, a move away from warrants as far as the sponsor economics go, and more towards common shares. In other areas, you've now seen a few recent transactions where they've taken that 20% as no longer a given, and have now tried to either scale it such that if the shares appreciate, you get some of your sponsors. But the vast majority of them still these days are based upon a 20% common share position from the sponsors of the SPAC, and then some sort of security dependent on their risk capital.
Okay, thanks, Jonas. Jared, what are some of the kind of new aspects or trends in M&A, and why are private equity sponsors so attracted to SPACs?
Sure. I mean, I think, you know, maybe PE sponsors just got tired of making so much money in the traditional PE space that they just wanted to try this out, I guess. Maybe that's the reason. No, I'm kidding. But I think the flexibility is, and the creativity is probably a top reason why sponsors are attracted to the market. I think also the ability, some sponsors just see the big numbers that other sponsors are raising and think that, why not us? I think I've heard that, informally. So I think being able to raise that amount of capital, sort of maintain control over the transaction, and plus you have sort of, if you're a sponsor, you get a decently large cushion of equity to play with, as Tina and Jonas have pointed out. You get that up front, but then, as negotiations go through, you sort of have that in your back pocket, where if you need to be creative and negotiate against, negotiate that down, I think it gives you a big tool to use if you need to get the deal done, which, as Jonas pointed out earlier, the wick is lit once you go public, so you have to get the deal done. I think that ticking clock sort of creates some pressure and drives the creativity, because once you find a target that you like and you have that sort of meeting of the minds, you and the target will be creative enough and work with each other enough to actually get the deal done. But I think, two interesting points for M&A. One is, I'm not entirely sure when it started, but I've noticed just a lot of target companies, shopping themselves lately, coming to all their advisors and saying, what do you think about us doing a SPAC? Instead of the SPACs being on the prowl, it's, almost the other way around now. That seems to be an interesting trend, and SPACs are just becoming a primary player in the market now, because there's a lot of capital put there outside of the PE context, outside of the public M&A context. You have this other player to sort of shoot for companies that may not be the right fit for a PE platform or a tack-on deal, but maybe they don't have just a perfect equity story to do a traditional IPO. But so the SPAC product comes into play, and it's just another way for sophisticated capital to get interesting deals done.
Jonas, next I'm going to take a question from our audience. What makes a target a good candidate for a SPAC? I know that's kind of a broad question there, but what types of things do sponsors look for when they're looking at SPAC targets?
I mean, there's a number of things. I think it depends a little bit about what industry that you're focused on. But you're typically looking for a private company. Ideally, has gone through some sort of institutional round or two, because that helps just institutionalize the company a little bit before they go public and think about it. Depending, once again, a little bit on industry, you're looking at a company that could be sufficient scale to warrant being public, has a growth story or some story that's going to capture the imagination of public investors, has comparable public companies that trade well, so that you come out with a story where you can show that your company should trade up to where some of your competitors are in the marketplace. Obviously, market leaders in a space are always great. In particular, in a space that I'm very active in the biotech space, you're really looking for, you're really looking for some support from some of the key investors that help underpin that, and typically focus on more venture-backed companies. In other areas, it could be a counter-cyclical play. So you may look to buy a group of assets in the energy play because you think that the markets will turn around. So those would be slightly different, dynamics at play about what would make an ideal target. A management team is critical. You want to have some depth of management that can not only drive the business forward in a public manner, but continue to hire and layer on the different elements that you'd like to see at a public company. And then you'd like to see some of the choices and decisions they've made. Have they made money for shareholders historically? Do they have a good board? Is that something that needs to be worked on? Have they hired sort of the right sort of team advisors around the table that could help them be a success? These are all sort of elements that I think SPAC teams, management teams look for. I would say that any SPAC team that before they go public that hasn't thought about where they're going to go on a target list isn't doing themselves a service. Obviously, you can't speak to any companies, but you should have a pretty good idea of where you want to go. And so these are the different elements that teams think about before they actually go public, and then they go after sort of their universe of relationships, and then other deal flow comes from everywhere else, and really keeping an eye on, or two eyes on, the market. it matters where the markets are, where sentiment is. You know, EV companies are doing well now because there's good support from a lot of different funds on the DSPAC, and it's a growth industry, and there's a lot of support for that in this market. You know, if things change, you know, be aware in other areas of the, you know, the other industries may be of greater interest. So these are some of the things to kind of keep in mind, I think.
Well, we're going to start on our next poll. Is our kind of prediction of the future. What will be the number of SPAC offerings in the next 12 months? Tina, do you have any further comments? I mean, obviously you get involved in the DSPAC process as well in finding candidates for SPACs. Do you have any comments or ideas of what makes a good SPAC candidate as well?
In terms of an issuer candidate or a target?
Target.
Yeah. I mean, I think some of the things that Jonas mentioned, I mean, they have to be ready to be public. This is at the end of the transaction, you're a public company, so public readiness is important. You know, having, as was discussed, a management team in place that's capable of communicating the story to public investors is really critical. You know, having a business that is in an area where equity investors want to deploy capital is important. It was just talked about as well. Having a company that where relative value can be established is also important. Sometimes you see SPAC transactions where, you know, the business is really unique and it's hard to compare it to any other existing company. Those are more challenging stories to tell. So, you know, that's probably a key consideration that gets overlooked sometimes. You know, making sure that there are good public comparables that, you know, are good constructs for value. You know, making the case that the company is well valued is also important. You know, having a transaction that's structured appropriately for the public market. So whether that's leverage, you know, for a company, obviously a lot of these high growth companies can't bear leverage, but there are plenty of large companies transacting with SPACs that are more mature businesses, and making sure the capital structure is appropriate. That's one of the key differences between a SPAC transaction and maybe private equity transactions. You can't use leverage, and also to the extent that you can a private equity trade, it has to be public company appropriate leverage, and the capital structure. You know, in terms of the existing owners having willingness to roll over their equity in the transaction. There have been, you know, a very small number of 100% cash out transactions in the history of the product, but in most successful SPAC transactions, there's a very meaningful equity rollover component. So, you know, oftentimes more than 50%, still more than you would, still more cash out potentially than you would see in an IPO, but a very healthy rollover component. And then, you know, going back to the readiness, it's not just readiness from a financials perspective. So obviously you need audits to fulfill the, you know, all the requirements for the filings, but you also need to have a company that has a good equity story, and where the access to the capital is helpful to the business, and it's not just you know, it's like as I said, not just sort of a cash out situation, but there's a real benefit to being public. So, you know, all of those things are important considerations. And there's probably a number of others, but those are the key ones that I would think about.
Yeah, as we see from our poll, our audience has a great optimism for SPACs. 37% predict there'll be 100 plus SPACs over the next 12 months, and another 24% says there'll be 75 to 100. So we have at least 61% that said there'll be 75 or more SPACs over the next 12 months.
Well, there was 78 just this year, so I think that's
right. Yeah, so we're definitely on an upward trend. Next, I'd like to talk, Jonas, are there any advantages or what's the market to do kind of follow-on capital once the SPAC is acquired? Are there kind of trends you see in that regard, or as far as in capital markets ability for once the SPAC process has occurred and the SPAC's been acquired, about the ability to obtain, whether it's through a PIPE or a follow-on type of secondary offering?
Yeah, I mean, what's interesting with the SPAC is you have some flexibility to size it in and around the transaction itself. And so of course, you have the capital that you want to access that's in the trust. You also have the ability to layer on a bridge financing, which can be a lot easier for some companies when they have a merge agreement and a public pathway ahead of them. So it does help private companies, access a bridge financing or a PIPE for equity capital. And then, as Tina mentioned, you can also layer on leverage through a transaction. So really the ability to size correctly the initial SPAC transaction, how much capital is needed for the company. The lion's share of SPACs also have a warrant outstanding, which has a callable feature. And so if the shares perform, you'd have the ability to access additional capital through that warrant. You look at the end of the business transaction of the de-SPAC, you're now a public company. And so, hopefully you've embarked on a significant amount of roadshow work throughout the process before you de-SPAC. And then on an ongoing basis, you would be looking to get analyst support and IR and building a public market story, which could lead you to a follow-on offering if need be, or a convertible note or whatever else you would need in the markets. You're now a public company, and you look and trade and have all the elements, and part of that is being able to access the capital markets. And so there's been plenty of transactions where you've seen them access the capital markets pretty quickly. I mean, even one of our transactions, Health Sciences, merged. There was a bridge financing of 35, it was 115 from the SPAC. 3 or 4 months later, they had accessed the money from the warrants as well as done a follow-on offering. So there was, kind of a march forward in ability to raise capital in being a public company. So everything's on the table, I think, de-SPAC.
Okay. We're getting kind of close near the end of our hour. I just wanted to give each of the panelists some final thoughts of maybe your closing words about SPACs, or maybe predictions for the future for SPACs of some key trends that may be evolving during the next 12 months. And let me start with Tina.
Okay. Yeah, I mean, I think you will see a continued, level of engagement with target companies, and I think that's the most important thing, frankly, because that's what keeps investors engaged. That's what allows IPOs to happen. It's the catalyst for IPOs happening. Is good deals getting announced. So I think you will see SPACs probably. They're over, about 45% of the IPO market this year, and I think you will continue to see them be, somewhere between, 30 and 50% of the IPO market. And I think you will also see, some very significant, well-known companies who choose to go public this way. So I think, they will continue to be a key part of the IPO market and a key part of the capital markets going forward.
David, any thoughts on predictions for the future?
Yeah, well, based on what we're seeing, I would concur with Tina. You're going to continue to see the trends that we're seeing. I don't, it's tough to guess how many issuances there are going to be, but certainly the trend of high quality companies with high quality management teams owned by high quality sponsors, wanting to merge with SPACs is becoming, much, much more normal. And I think that's a trend, success breeds success, right? As we see people do good deals and the stocks trade well, then they have liquidity, they pick up equity research coverage, and 6 months later, you stop somebody on the street, and everybody knows DraftKings, or everybody's heard of Virgin Galactic, but very few, except people listening to this, know that they went public through a SPAC, right? So it's just a way to get your company the capital that it needs to grow. And I think more and more high quality companies are going to, continue to go the SPAC route. It's going to become the the IPO of choice, which I think we're seeing already.
Jonas, your thoughts on predictions for the future and evolving trends?
Yeah, I mean, I think the short to medium term, we're going to continue to see a lot of new issuance. I think you're going to have a situation where if the markets do take a bit of a downturn, there will be a lot of larger SPACs looking for transactions, and large SPACs have to find large targets and have to have an open capital markets to work. And so always be mindful, there's a lot of momentum to do larger deals because, it allows you to target larger companies as well. I think, in the next downturn, we're going to see, who comes out of that strongest. And so there is some risk that there's going to be too many of them out there. So I think niche players, entrepreneurs who really understand an area, private equity that really, has depth in certain areas will be the ones that'll outperform. So really being thoughtful and concise about where it is that you think you can file deal flow and add value is going to be critical. But I continue to see this long-term being very constructive, being a growing part of the overall IPO market. It's a very good solution for private companies, and so very positive on where things can go.
And then I'll turn it over to Jared for your response to the marketplace and predictions for the next 12 months.
Yeah, sure. Predictions wise, I don't know if I'm the best person to ask about that. I don't. If I could see the future, probably wouldn't have been a lawyer to begin with. But I'll put that one to the side. I do think SPACs are going to be here for the foreseeable future. They fill an interesting hole in the M&A market, and I think they're attractive and only gaining momentum. But I think parting words for sponsors and target companies. Tina alluded to this earlier. At the end of the day, you're a public company, and make sure that's what you actually want. It's not always the easiest thing to do. It takes a lot of preparation and sort of just a different mindset in terms of disclosure and corporate governance and things like that. There's the exchange rules and the SEC. There's just a lot to think about and prepare for. So that's the best advice I have to everyone wanting to do a SPAC is make sure that's what you want to do.
Yeah, I agree with all those comments. I know here in Silicon Valley, we're seeing a tremendous amount of interest. A lot of venture funds as well as tech-focused private equity funds are looking at sponsoring SPACs, and we've had numerous tech companies that are looking at SPACs, and evidence of the explosion really in the electronic vehicle and auto tech industry, where we've seen numerous SPAC acquisitions, whether it's Nikola or Fisker or Luminar. Canoe was another recently announced. So I think we'll see a lot more tech-focused SPACs here in the future as well. But I want to thank everyone. That's a wrap for our first joint New York Silicon Valley ACG event. I want to thank our great panel and our sponsors and attendees, as well as the ACG. And we look forward to our future ACG events, and I'm sure we'll have a follow-on SPAC event in the future as well. Thank you.
Thank you.
Thanks, everyone.
Thank you.